Hey guys, Max here, and this is your daily market update for yesterday, the 17th of February. And it went pretty badly, to be honest. Stocks fell across the board. I think 80% of the stocks that make up the S&P 500 actually closed in the red for the day, including some very big names like Apple and Google. Now, before we get into it, there is a storm in the US, and behind me is a fireplace with a chimney, so if you can hear the wind coming down it, I apologize, but there's really not a whole lot I can do. Now, getting into the actual topics for the day, the indices obviously didn't have a good time. The S&P 500 closed down over 2% and didn't really have any positive movement all day. The same story was seen with the Nasdaq, except the fall was even more drastic, as you might expect, falling just under 3% for the day. Equities around the world actually didn't perform too well, but losses were concentrated in markets that are most likely to be impacted directly by a conflict in Ukraine, so Europe and the US. Fear was very high, as was measured volatility, which saw the VIX spike up to 28. Investors got worried, and so basically they sold off some risk on assets and moved into assets that should perform a little bit better during times of lots of fear, like treasuries, bonds, and gold. The US 10-year Treasury yield fell 8 basis points and it now sits just under 2%, and there's similar stuff seen all over the world elsewhere, with safe and reliable government bonds getting bought up and their yields falling. Gold as well, being seen as a safe haven, has been getting lots of inflows recently and its price has been rising, and yesterday gold broke $1,900 an ounce after spending what felt like forever sitting around $1,800. One thing that was a little bit surprising was that oil prices actually fell, which isn't what you would expect considering everything else that happened in the markets. WTI crude oil fell 2.2% yesterday and it's now sitting just above $91 a barrel, still very high, but as tensions in Ukraine have been deteriorating, I would have expected to see prices rise if anything. Now, crypto markets actually saw tough times as well, with pretty much everything declining by about 5%. Now, this makes perfect sense. They are risky assets and they're no longer niche, so as investor worries grow and people's risk tolerances decrease, people trim their riskiest positions first, which is almost always going to be the crypto in their portfolio if it's there. This also pushes further forward the idea that crypto is a risk-on asset. It is highly correlated to traditional financial markets and it's basically just a proxy for tech or innovative companies. As of right now, Bitcoin is sitting just above $40,000 and Ethereum is sitting just below $2,900, so a 5 or 6% decline from yesterday. And if you pick a random altcoin out of the bag, it probably performed somewhat similar, losing something like 5% of its value. So that's what actually happened in the markets, but why did it happen? Well, it's the same stuff we've been hearing for a few weeks now. Two risks coming together and rattling markets, and that is the risk of a conflict in Ukraine and the risk of tightening monetary policy in the United States. Now, this really shouldn't surprise us. It should be expected. There are a few developments to talk about briefly, though. The first is surrounding Ukraine, and it comes off of the back of some better sentiment a few days ago. Basically, Russia announced that their troops were starting to withdraw from the border of Ukraine and that they would be sending all their troops back to their usual bases. No invasion was coming. All good news, apparently. This encouraged markets. It made people a little bit happier, a little bit more confident. Capital flowed back into high-risk assets like Nasdaq-listed tech companies that burn money and cryptocurrency, so markets rose. The problem we're seeing now is that there doesn't actually seem to be any evidence of Russian troops actually leaving. Russia said they would, or they actually said that they already are, but that doesn't seem to be the case, so markets have turned right back around and they're panicking again. This is then made worse by the fact that the US, NATO, and the West in general are still putting out a lot of warnings of what Russia might be about to do. The most recent warning is that Russia is planning a false flag attack to justify an invasion, and Western armed forces are still expecting, or at least they're telling us that they're expecting an invasion to start very shortly. Now this we've heard before multiple times even over the last week or two, but yesterday Russian separatists in the Donbass region shelled an urban area and hit a nursery or a kindergarten, I think they're called in the US. 2 teachers were wounded. The US embassy appears to be burning documents preparing for an evacuation in the event of an invasion, and Russia expelled the deputy ambassador from their country. Basically, tensions aren't easing, they're getting worse. The situation seems to be deteriorating, threats are still being made by both sides, and I know that there's a lot of doubt going around about whether or not the West actually does think that an invasion is likely, but the actions of foreign embassies in Ukraine and the like, it does seem to be suggesting that there is at least a distant possibility of an invasion. The truth is, there is so much nuance at play here. These developments will have a lot of consequences, and so I will be putting out a second video later in the day talking exclusively about the situation in Ukraine for those who want to hear my thoughts on it. Those who don't can rest assured that that is it for Ukraine on this video today. Now, the second reason the markets declined so rapidly yesterday is, of course, the fear of what the Fed might do, how inflation might develop, and just a tighter economy in general. James Bullard, who we've been talking about quite a lot recently, came out and reiterated his position that an interest rate hike of 1% by July is essential and that the balance sheet needs to be actively shrunk by the second quarter of 2022 as well. Now, we've heard Bullard say this before, but more people and more institutions are starting to agree with him. A Credit Suisse analyst, Zoltan Pozsar, is claiming that we need a Volcker-style shock to halt inflation and drive asset prices down if we want to avoid a recession. Now, lots of people might think that if asset prices collapse, that might cause a recession itself, as it would panic lots of people, financial institutions and banks would lay people off, and this would all cause consumer spending to collapse and stuff like that. But this analyst's reasoning is that extremely high asset prices are pushing us towards a recession because so many people have retired early, and that's the reason the labor force is so tight and supply side shocks are not being solved, and I can see the argument behind that as well. The thing is here, no one really knows if asset prices crashing would cause a recession or save us from one. It could go either way, but we are undoubtedly going to find out over the next year or two as valuations continue to decline. Now, in specific company news, Nvidia came out with their earnings and they were really strong. They literally doubled their profits from last year. Their margins are far higher than their competitors. They're still growing as well, but their share price still collapsed 8% on what seemed to be good news on the surface. So why did the company's price drop on such huge growth? Well, it was valued extremely highly. Its PE, its price to earnings, is still sitting around 75 after that dip, and their guidance for future growth was not what investors had hoped. This is a perfect example of valuations just decreasing as the capital environment changes, and it's hard for a lot of people to understand why. Take a look at a Reddit thread about Nvidia's earnings and you'll see lots of people asking why the stock is dropping when it's still growing, and it's very simple. It's still an expensive stock, and guidance for future growth is not enough to justify its current value, especially as the monetary environment changes. Now, on the other end of the spectrum, Facebook, or Meta, I'm just going to call it Facebook, it's continued to get absolutely hammered by the markets, and it fell 4% yesterday alone, and it's nearing in on only being worth $500 billion. Now that sounds like a lot, and it is, but when it used to be a $1 trillion company or close to it, that's a big hit. Now here, I think I'm going to surprise some people when I say it's actually sitting at a pretty fair and decent valuation right now, and it's a fair buy. However, I'm still not going to be buying because Facebook does not exist in a vacuum, and as the investor and risk environment continues to deteriorate, I fully expect Facebook to continue to fall with the rest of the market. That is it for the day. As I said earlier, we will be back later on for a video looking into the nuances of the situation in Ukraine. If you enjoyed this video, then leave a like and a comment to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that allows you to buy fractional shares of art from world-famous artists like Banksy, which can be a great way to diversify your portfolio with non-market correlated assets. It's completely free to sign up, you don't have to buy anything, you don't have to hand over any card information, so if that sounds interesting, then make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get 9% interest on stablecoins like USDC, which is a far higher rate than you'll get from any savings account these days. Just make sure not to use Tether. Thank you all for the support. Thanks for watching. Stay stoic. Until next time.